Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Asbury Automotive Group Inc. Annual Report. Asbury Automotive Group Inc. offers a wide range of automotive products and services to individual retail customers, other dealers, and licensed wholesalers. The company operates through two main segments: dealerships and Total Care Auto, powered by Landcar TCA. In the dealership segment, Asbury provides new and used vehicles, vehicle repair and maintenance services, replacement parts, collision repair, and reconditioning of used vehicles. In addition to these core products and services, Asbury also offers finance and insurance products. This includes arranging vehicle financing through third parties and providing various types of insurance coverage. Furthermore, the company offers aftermarket products such as extended service contracts, guaranteed asset protection, prepaid maintenance contracts, key replacement contracts, paintless dent repair contracts, appearance protection contracts, tire and wheel contracts, and lease wear and tear contracts. Overall, Asbury Automotive Group, Inc. provides a comprehensive range of automotive products and services to meet the needs of its customers. The stock price of Asbury Automotive Group Inc. has dropped by over 17.5% in the past year due to several factors and news events. One significant contributor was the company's fourth quarter and full year 2025 financial results, which showed a decrease in net income by 53% compared to Q4 2024. This perceived margin compression and the miss on revenue despite slight EPS beat contributed to a negative market reaction. Investor concerns regarding the company's and a strategy versus share repurchases also played a role. A Seeking Alpha article highlighted that investors were not pleased with the focus on mergers and acquisitions over share buybacks, which led to the stock's underperformance. Additionally, analyst downgrades and price target reductions further contributed to the decline in stock price. The general market sentiment and industry conditions also likely had an impact. The company operates in a tough new car selling environment with affordability challenges for buyers. While Asbury Automotive Group has seen growth in revenue, its net income decreased significantly, suggesting a compression in profitability that concerned investors. Overall, these factors combined to cause the stock price drop of over 17.5% in the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for the company can be attributed to several key factors. The acquisition of Herb Chambers in 2025 was a significant contributor to revenue growth, with its 33 dealerships, 52 franchises, and 3 collision centers adding substantial revenue streams. Additionally, new vehicle sales increased by $132 million, 9% growth, in 2025 compared to the previous year, while used vehicle sales and parts and accessories sales also experienced growth of 5%. Furthermore, F&I revenue grew significantly, contributing to the overall revenue increase. On the other hand, there were several drivers of revenue decline. The exclusion of Koons Lexus of Wilmington from the company's operations was a notable factor, as well as asset impairments totaling $117.2 million. Additionally, a decrease in advertising expense also contributed to the decline in revenue. The summaries provide a comprehensive analysis of the company's financial performance, highlighting both the drivers of revenue growth and decline. By examining these factors, stakeholders can gain a deeper understanding of the company's financial dynamics and make informed decisions about its future direction. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 28.6% from $602.5 million to $430.3 million in 2024. However, this trend was reversed in 2025, with an increase of 14.2% to $492 million. The profit margins also experienced a decline across various segments. The gross profit margin decreased by 9 basis points from 17.2% to 17.1%. Additionally, the new vehicle, luxury segment, import segment, and domestic segment gross margins declined by 0.7%, 0.6%, 0.9%, and 0.8% respectively. The reasons behind these changes are multifaceted. A decrease in new vehicle sales was a significant contributing factor. Furthermore, manufacturers struggled to adapt to the increasing demand for electric, battery-powered, and hybrid, gas/electric vehicles. This shift in consumer preference led manufacturers to divert resources away from traditional production models and invest in clean vehicles and new technologies. The inadequate supply of historically popular vehicles also played a role in the decline of profit margins. Lastly, asset impairments and lower revenue contributed to the overall decrease in net income and profit margins. The company's ability to generate positive operating cash flow is a mixed bag. On one hand, there are several instances where it is clear that the company is producing positive operating cash flow. For example, on page 72, we see that net cash provided by operating activities was $775.20 in 2025 and $671.20 in 2024. Additionally, pages 77 and 126 explicitly state that the company is generating positive operating cash flow. However, there are also instances where it is unclear or negative. On page 17, we see no clear indication of positive operating cash flow, while on page 47, it is likely that the company is generating negative operating cash flow based on the information provided. Furthermore, pages 22 and 23 provide no relevant information to determine if the company is generating positive operating cash flow. The inconsistency in the data makes it difficult to draw a definitive conclusion about the company's ability to generate positive operating cash flow. While there are some clear instances of positive operating cash flow, there are also indications that the company may be struggling with negative or unclear operating cash flows. The company's debt level has undergone significant changes over the past year. Total debt outstanding decreased from $3,593,400,000 to $3,158,500,000, while long-term debt also saw a decrease from $3,572,000,000 to $3,023,900,000. The 2018 BOF-A real estate facility was paid off in November 2025, and the 2021 real estate facility decreased by over $137 million between 2024 and 2025. However, despite these decreases, the company still has significant debt commitments, including an ability to increase facilities by up to $750 million. The total mortgage notes payable outstanding was $27.2 million as of December 31, 2025, down from $29.6 million in 2024. In terms of interest expenses, there are mixed signals. Floor plan interest expense increased significantly from $9.60, 2023, to $91.20, 2025, while other interest expense, net decreased from -$180.10, 2024, to -$188.50, 2025. Total interest expenses also saw a decrease, but the exact comparison is not possible due to lack of data for previous years. Overall, the company's debt level has decreased significantly over the past year, but interest expenses have been affected in different ways, with some increasing and others decreasing. The performance of various segments within the company can be summarized as follows. The dealership segment showed no signs of poor performance and even experienced an increase in segment operating income. On the other hand, the TCA, Vehicle Protection Products, segment struggled due to claims expense incurred. In terms of regional performance, it is worth noting that the TCA segment's poor showing was not limited to one specific region. Instead, it appears to be a company-wide issue affecting both the vehicle protection products and total company asset segments. The dealership segment, however, seems to have performed consistently well across different regions. Overall, while some segments of the company experienced growth, others faced challenges that impacted their performance. Management is projecting a cautious yet strategic approach to the company's future. The strong financial position, with substantial debt service obligations, indicates a focus on maintaining stability and managing risk. Capital expenditures are expected to continue, prioritizing upgrades and expansions that will drive growth and competitiveness. The integration of acquisitions into the business is a key component of management's strategy, aiming to unlock operational synergies and future economic benefits. Revenue recognition follows industry standards, ensuring transparency and consistency in financial reporting. Compliance with tax laws and environmental regulations is also emphasized, demonstrating a commitment to responsible business practices. Risk management is another critical aspect of management's approach, utilizing derivative financial instruments and self-insurance programs to mitigate potential threats. Overall, the strategy appears to balance short-term stability with long-term growth initiatives, positioning the company for sustained success in its industry. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has expanded its portfolio by purchasing TCA in December 2021, Coons in 2023, and Herb Chambers for $1.76 billion on July 21, 2025. These acquisitions are expected to bring in new revenue streams and enhance the company's market presence. On the other hand, the company has also made divestitures, which involve selling off certain assets or businesses that no longer align with its strategic goals. The divestitures include repayments associated with previous sales totaling $1,018.9 million in 2023, as well as a non-cash impairment charge of $115 million due to underperforming dealerships. Additionally, the company has written off $26 million in asset value for dealerships that met the criteria for sale in 2025. Overall, these acquisitions and divestitures demonstrate the company's commitment to strategic growth and optimization of its portfolio. The company's financial activities have been transparent in their annual reports. One notable aspect is the absence of dividend payments to shareholders. Despite this, the company has engaged in share buybacks, indicating a focus on returning value to its investors through other means. A significant portion of shares has been repurchased by the company, totaling $212 billion. This suggests that management believes the stock price is undervalued and seeks to reduce the number of outstanding shares. The maximum number of shares that may yet be purchased is slightly lower at $212 billion, implying a strategic approach to share buybacks. Concerns about inventory buildup and supply chain disruptions are evident in the industry. Inventory buildup is a pressing issue, as indicated by a $96.5 million increase in 2025 compared to 2024. This trend was also observed in 2024, where there was a potential buildup due to a $24.8 million decrease in inventory from 2023 to 2024. Supply chain disruptions are another significant concern. Production and delivery of new vehicles and parts have been affected by the lack of availability of parts and key components from suppliers. Natural disasters, pandemics, wars, conflicts, and other reasons can also cause popular vehicles to be difficult to obtain from manufacturers. Furthermore, supply chain disruptions due to natural disasters, adverse weather, pandemics, tariffs, labor stoppages, wars, and conflicts have been reported. The industry is facing challenges on both fronts, with inventory buildup and supply chain disruptions contributing to the increase in SAR for new vehicle sales. The high inventory supply, including fleet, has contributed to this trend. Additionally, $343.1 million in new vehicle inventory outstanding under the floor plan facility with Ford Credit may be related to supply chain disruptions. The used vehicle market is also experiencing issues, with potential problems in sales and inventory management. Days of supply in used vehicle inventory, used vehicle units sold at less than original cost as a percentage of total used vehicles sold, an average vehicle selling price of used vehicle units sold at less than original cost suggest that the industry needs to address these concerns to maintain a healthy market. That concludes the financial summary for Asbury Automotive Group Inc. Feel free to comment below, and I will be happy to answer them when possible.